All right, so stock started the week on a very interesting note today. Kind of more of a risk-off day, except for what we saw in small-cap stocks. A lot of these these small-cap meme-type stocks, reopening-type stocks, really took off today. To some of them, a very, very large degree. An extreme gap to the upside, extreme moves, lots of volume. So needless to say, the Russell 2000 was the story of the day. The issue is this is not the first time that that's been the case, and will this turn out the way that the other times did? So we're going to break that down in today's video. What some of the other asset classes did today, which is a very fascinating pattern because some things move together that typically don't move together, and then like I said, IWM kind of did its own thing. So we're going to see what everybody else did, and then as well as from a sector standpoint. Well, who started the day strong, who ended the day strong. And then we're going to take a look at our trade idea of a stock that's had a really good rally right up into a lot of the same resistance levels we're seeing on the broad markets themselves, and talk about how to trade that. So let's go ahead and get started. Today is Monday, August the 8th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going, I invite you to subscribe to our YouTube channel, like our video, click that thumbs up down there, comment on the video down there as well. Join our website at MarketScholars.com, use that link there. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. Also, if you're watching here on our blog, as you check out some of these things on the right, come down here, click on this heart. It opens up this tab, hit that like button there. Same thing here, click that thumbs up icon, opens up another new tab, hit that like button. Again, the more you do that, it helps get our content out to all of our followers that are following us on those social media platforms. Let's start off taking a look at the S&P 500 with the market forecast indicator. So again, this is what our 5th down day in the last 6 sessions. Look at this is interesting. 1, 2, 3, 4, 5 out of 6 sessions. And in those 6 sessions, we have gained almost 10 points. So we're down 5 out of 6 sessions. And over the course of those entire 6 sessions, we're up 10 points. That's kind of shows you what's been going on. And that also kind of shows you what a convergence looks like. When you got a good divergent move and then you start to lose the momentum. You're not dropping, but you're not really bullish anymore, at least with the same momentum that you had. And I'll show you that here on another chart when we get into convergence mode. Obviously, you're in this bearish divergence mode, so you have this lower highs with the near-term line combined with slightly higher highs in the actual price itself. The low point in between being the signal of the trend change. In this case, it would be an intermediate trend change. You'd have to get below, what would this be, 40.80 roughly from August the 2nd, that low point. Obviously, there would be some other levels. Fibonacci lines kind of sitting at that level too. The near-term line's down, but it's not in bearish territory. The momentum line's down and didn't get in the bearish territory either. So this is hardly that big of a decline. In fact, over the course of the 6 days, the near-term line has been in neutral territory 3 of those sessions, but not in bearish territory any one of them. So to get a 5 out of 6 day streak without the near-term line dropping in the bearish territory is pretty rare. But that's what we're getting right now. The intermediate line is still a very strong level. That's why it's not falling. Like, we're not really that bearish. The intermediate line is still very strongly bullish. Market sentiment line's rising, a little slowing down a little bit, obviously because we're not really gaining that momentum anymore. So that's kind of slowing it down. And then, again, we're about 5%. So, again, when we fall below the 2.5% mark is, kind of where we start to worry about not being as bullish anymore. But even then, being above this 2.5%, let me get rid of this line here. This is the 5% mark. Getting above the 2.5% mark is really only needed to start a bullish trend. You can see it kind of is a limit after that when you're just in a bullish trend. But to start one, you really need to get up and get going, and that's you need to get far enough above the moving average that you can stay above it, while not necessarily maintaining the same pace. So that's kind of the idea there. We don't really need to be worried about like a bearish trend until we get back below the 2.5% mark, which is that red line down there. Let's take a look at the NASDAQ 100. Very similar pattern. A little bit of an upper shadow here, a bigger upper shadow than what we've seen in a while. Near term line's down, but not in bearish territory. The momentum line is in bearish territory, but not extremely oversold in the least bit. So very similar. You can see again, like the S&P 500, you notice is up against this 23% retracement level I highlighted on Friday. Very, very important level. 50% of this current intermediate run. The 50% line of the longer term drop is right above that. So we're kind of in this important resistance level, 4,200 that we've highlighted before. The NASDAQ and Russell, it's a little bit more significant because you've got these red and black lines, which are major long-term resistance support levels. Obviously support if you're above it, resistance if you're below it. And acting right now as resistance since we're coming up towards it. And then you got the 38% retracement of this long-term drop that we're on, all lined up together, 50% of this intermediate decline. So very, very important level that we're sitting on that's having a hard time to get through. And then, of course, the Russell 2000, which has been more bullish, which was actually up today. Everything else is down, but the Russell is up. Much, much more significant divergence, right? The lower highs with obviously a much higher high. And this high, we are at the highest level at 100 percentile. So this is the highest level we've been away from the 30-day moving average, about almost 8%. Real significant move. And then the other instance too is the other thing that stands out here is that we have about a couple of days where we almost got clusters, right? There's actually a third day over here where we almost got clusters, but this too, like we were at 79 and a quarter. We were just 75 basis points on that momentum line away from a cluster. And then right now we're at 76, or at least, we're above 75 in all three of these lines. So it's not technically a cluster where you get the red dot, everything's above 80, but it's about as close as you can be without getting one. And you notice, again, multiple resistance levels sitting on top of each other. The 23% line from this big bull market run we've been on since March 2009, right? That we broke below that, finally, we hit it multiple times and finally broke below it. The 38% retracement of this long-term decline that we've been in, this market sentiment decline we've been in, and then of course the 62% retracement of this current intermediate decline that we've been on since really that peak there, last overbought cluster. And it's interesting too, what stands out, if you follow me on Twitter here, let me bring this over and you can see it. If you follow me on Twitter, I tweeted this out about the Russell 2000. One of the biggest drivers for the Russell 2000's move is Bed Bath & Beyond. A lot of these meme stocks, Bed Bath & Beyond, one of them. And you notice we really gapped up significantly, 40% higher. Like that's after coming off the highs that we were 40% higher. Gapped up sharply. Look at the volume down there. Extreme amounts of volume. This is not the first time. See, we had a big spike, a big gap, and we fell throughout the day. Not as, we fell more. We didn't fall as much today as we did those days because we opened up at those levels and fell throughout. Here we opened up, rallied early, and then came down all day long. So that's, that we had a spike in volume there, and you notice that it didn't set the peak on that day, but it set the peak for this bullishness. We never did get high. We never got above that high. And then we finally filled in the gap when we were bearish. And we did it over here too. Big spike in volume, big gap higher, fell throughout the day. We still kind of retested, and then we fell. We never did get higher. In this case, never did get above the 200-day moving average there. If you look at the Russell 2000 now, this is the first time that happened on Bed Bath & Beyond, this move right here. And then this is the second time it happened. So both these peaks, on the intermediate peaks on the Russell 2000 occurred with these kind of, quasi blow-off top type moves on these, individual components of the Russell 2000 to where they pretty much, again, like I said, kind of a blow-off top. And it really wasn't that bullish to get to that level. We've been pretty bullish here. We were already pretty bullish just to get to the 50. And then on Friday, we blew through the 50. And today, gapping up for it and finishing up 40%. I mean, that's just on a tremendous amount of volume. Again, we've seen this pattern before. That doesn't mean that this is the high, though. This is the first time we have a long upper shadow. So that's a little different than what we saw over here. And you got, now you've got this volume resistance on top of you, whereas over here you didn't. You just had a little bit of resistance above you. But now you have some significant resistance on top of us, as well as the 200. You've pretty much filled in the gap between the 50 and the 200 in one fell swoop. We've seen what happens these other two times. Both those instances created the new legs lower, intermediate legs lower. Now you break above this 1940-ish level, 1950, 60 level. All these lines get up here, and there's some dotted lines, but they're not nearly as strong. This 2000, 2100 level right here, this 23% retracement would kind of be the last straw. But we kind of had a fake out move there above that line, and then broke down hard off of that. It looks very similar. The type of move we saw today seems pretty darn similar to that move that we saw in March. Again, that was accompanied by a tremendous move higher. This was actually the beginning, so we didn't get the end of March is when we actually retested that peak. So the peak was actually in early March that we got that big move, and then retested it. So we're looking pretty similar type moves that we have on each of those. Otherwise, aside from that, we're in this good bullish move higher. Obviously, the week's not over yet; just barely started. But we're getting, a higher close. We're not quite closing above the high. We're not getting above the 40-week exponential moving average quite yet on the Hakinyashi. But at least there's a green arrow and the PPO is rising, and you got a positive differential. So you have all three things that you really need to see on that particular chart. Then you break down to some of these others. Still got 3 green arrows across the board. All across the board, 3 green arrows. The problem is that MACD on all of them except for the Russell, which appears to maybe have a blow off top type move here. Here's what it looks like. Again, a pretty decent amount of volume, relatively speaking, over the past week. But then this gap higher has a very exhaustion gap type of element to it. Again, especially when we compare it on its individual components. But all of these about to get red arrows on the moving averages, and that's when you start to get in convergence mode, and that's kind of what I talked about earlier. When the MACD crosses below its moving average, but we're still above the 17-day, or at least the second number in the MACD, whatever it is, a lot of you may use the 1226. So as soon if the MACD is below its moving average, but you're still above the 26-day, then you would be in convergence mode, and that means that the market's really not going anywhere. It's not rising anymore with that same momentum when you're in divergence mode, but it's also not falling quite strongly yet, not until you break the 17-day. And when there's big strong gaps between these 3 lines, it's hard to really get going to the downside pretty sharply. You need them to converge, these lines to converge to where you can break multiple lines at once, like it did here on this day. That's when it really started to break down, and you can see like this line too. You broke through multiple lines. 30, 50, 8, 17, all in one day because they had converged on each other, and then you break down. So obviously we're not converged here, so I'm not quite sure necessarily that we'll break down hard like these other 2 times. But it definitely appears that we might be, again, heading up against some resistance. In this case, like I said, that 23% line, you got that volume node there as well. If you look at the Qs and the IWM, and you look at their volume profiles, there's also some volume resistance, some bigger volume nodes that we're seeing at each of these levels, a little bit higher on the Russell. So there might be a little bit of wiggle room there. But you can kind of see why we're starting to move towards convergence. It's hard to get through resistance, especially when you've used a lot of momentum just to get to it. It's kind of like, making a comeback in the basketball game. And when you're down 20, 30 points, you've used so much energy just to get back to break even. It's hard to get over the top and really finish the game on top. It's the same thing, right, that we're seeing here. Now let's take a look at some of these other oscillators, like the DMI, for example. We're still, breakout. We're in green shading, so your ADX is rising because you're above 30, you're below 20. So we're actually still in pretty good shape. From a lot of these indicators. The RSI is still above 60, not quite breaking above 70, which is what you need to see to break from one trend to the other trend, right? To get from bearish to bullish. So we're not quite getting that. When you break from one trend to the next trend, you need to break out. That really helps for you to be able to break out and sustain that move for a while. We haven't got that yet. And you got a little bit of a divergence here on the CCI. that might steer us down towards this 39.25 level on there. That's the S&P. Of course, the Russell did get above 70, and you notice it didn't quite get above 70. Only got above 60 there in March, but in November it did. It really busted up to the upside here. So it's a pretty extreme level again. But the problem is it's hitting that extreme level, not having broken through resistance already. It's getting to that level at a major resistance level. Again, multiple significant Fibonacci levels sitting right on top of each other here in this 1940 to 1960 area. Looking at the Ichimoku cloud, obviously we got a good intermediate strength trend going. Not really a good mature trend that can be sustained yet. Right, need to get above 5, need to get above 80. We're not quite there yet in the S&P. We're closer on the NASDAQ. We're almost to 5. We're at 82 on down there at the bottom, and then your IWM again not quite at either level. Even though we're getting we're above the cloud on all of these indicators, and if we can stay above the cloud by the time we get to the green shading, then we're going to be in trending mode. Okay, looking at volatility today, volatility had this interesting move as it always does on Mondays, right? It rallied up, did not finish the day after gapping up. We actually came back down into the gap, still finished with a small gain to the upside. At above 20, we are in bullish territory in terms of risk appetite, below the 90th percentile, but we're still not below that 20 level yet. And also keep in mind too that the volatility of the VIX is down to its lowest, it's down to a still low level near 85, and in this case at 87. What's interesting about the volatility of the VIX here is that the gap between the average value, which would be the 50-day and 200-day, it was simple. Let's get rid of these other indicators. The value down here at 18% is the lowest value that we've ever seen. Like, this is the biggest, fastest drop in the volatility of the VIX. Again, that we have, looking at the gap between the 50 and 200 day. Let me just kind of show you the 10% mark here. Let me put on 10%. Oops. Put on the 10% mark, and we kind of have a common area to compare to. So obviously we are well below that. In 2019 we got below it at the very beginning when we came off that Q4 2018 correction low point. 16 we got below it when we came off that 15-16 correction low point. We got right going into that correction, we were down at those levels, and then in 14 and 13 you can see we were down at these levels too. Needless to say, again, that's around 10%. We are at 18%. Big, fast drop in volatility, which is fine. It's like we don't have to always stay up to the upside, but the length of time, the fact that we've been down for so long, and it's about the 50 down, we dropped so hard away from the 200 day average value, and we've stayed down now for so long that the 50 day is caught up, then that's just widened this gap that, again, it's pretty easy to fill when you've got a gap that big to the downside. When you get that big and we start to turn up, you fill it up back up to the upside. Again, we hit this extreme low back over here. Would that be last Friday? Not this last Friday, but the one before that. And then you can see we've been on convergence mode ever since, and now being above the 17-day moving average before the MACD turned higher. Kind of suggests that the MACD may be close to turning higher, which means that this volatility of the VIX might also start to leg higher again. See, again, and I've shown you this before, but considering also the seasonality of the chart, the seasonality of this tends to be bullish right now, heading into pretty much August expiration, and then again into October earnings season, lining up with also a bullish time in the VIX that, really from the low point in the VIX, from the seasonal low in the VIX, we're actually kept going down. So we're kind of delayed a little bit and what is typically a pretty seasonally bullish move on volatility through August, September into the end of October. Today's move, obviously we had a gap up to the upside. Let's see, not this chart. Here we go. We had a gap up to the upside, but we filled it in. There's still some gaps over here we need to fill in, and one from over here we need to fill in. So not quite done, and we came back into last week's range after getting up above last week's range. We did get a higher high and a higher low. We did not close though above the high. So again, a little bearish, not as bullish, not really as bearish either, because you still have the higher high and the higher low. And really, we don't get bearish until you break through this week's range here. But the problem is, if we do break through this week's low point, then there's no volume here. You have a really low volume area. If you look at the range today and 5 points, just under 7-point average, and we were just under 6. The volume at 54 million. Put those numbers in average, again under 6, and then 54 million is way down there. Again, we're really kind of coming down here. Again, very similar to what we saw at the end of March and April, toward this 1.5% mark. I showed you the McClellan oscillator making its way slightly above the 500 level. The other kind of thing to watch with that goes along with that is the new highs and new lows index, which you can see also broke above 0 today. Now, it did that in the end of March. Did that there too. Remember, these were the days here that not only did we have some bullishness here, but those were also the time frames when all these little small stocks, these meme stocks, these Russell 2000 type stocks did really, really well. That's what pushed them up to new highs, and obviously you can see a net basis of 87, so not above 100. We didn't get above 100 over here in the beginning of the year. We didn't get above 100 over there in March. We didn't get above 100 there in December when we were trying to come off that November low point where the Best Buy had spiked. So those are kind of things from a breadth standpoint we kind of need to see. It looks like we're just right there on the cusp of a good, solid, trending move. If we can get through this old high point and start a new high. Otherwise, if we hold this level for resistance, then like I said before, the probably more likely scenario is we end up with a low point again in this area, kind of like what we did there. It's hard to come off of it. This is how head and shoulders patterns are formed. It's hard to form a higher high off of a lower low, unless it's like a divergent low where you're just barely slightly lower, and then all the corresponding oscillators are forming higher lows. But this was significantly lower. It wasn't a divergent low point. So it was a lower low and not even close to a divergence. So unless it's that, it's hard to get a higher high coming off of a lower low. It's easier to get a higher high coming off of a higher low, which is probably what your market's going to set you up for, is to produce a higher low that ultimately you can get through to a higher high with, instead of trying to do it off of, like I said, a significantly lower low. All right, and then I showed you the VIX. The VIX chart's really the only last thing, and again you can see it on the daily chart, where we're at from a bullish standpoint. But again, you can also see too that the VIX is converging, right? We've been down, we're below the 200-day average. We have been for a while, but that MACD, we don't have any momentum anymore to the downside because the volatility of the VIX is so low. And so that, we're kind of setting up some kind of basing pattern here. It's not too common when you don't have a lot of momentum. The VIX is just nothing but momentum moves pretty much from in one direction to the other. You can see it plotted out here on, it'd be the TTM squeeze. Let me go to the VIX. You can see it's pretty much, we are trending move. You get these trending moves in one direction or the other. And we have not been in a trending move, and the bands are slightly outside, but you can see they're still all pointed down. So not a whole lot to that green dot. There's just not really a trend going on right now. The MACD is just really flat. The VIX isn't really going anywhere. Again, a function of how low the VVIX is. You can see the MACD is just the histogram bars are just so low. It's not very common. You can kind of go back out and see. It's not very common to get that. Usually that MACD is really moving. We're getting momentum moves up or down, up or down, up or down. And right now we've been down, but we're not going down anymore. And you can kind of see the consolidation forming on both of these, setting up for either a break below 20 where we can really get going and stay down, or kind of like this right here where we're kind of consolidating. It's almost the exact same pattern right here in March of last year. And then we broke down in April, and we stayed bullish on the markets for an extended period, multi-months, right, all the way through the end of the year. So we're set up for that kind of move where we're kind of converging, and then we finally broke 20 and stayed there. That's kind of what it looks like it's trying to do. We're either going to do what we did in March and bounce off of it and head back up, or we're going to do what we did last March and break down and then stay down and stay in a bullish trend, most likely up to new highs by the end of the year. So which way do you think you're leaning? Let me know in the comment section below. And what charts are you looking at that suggest why you are leaning that way, either to the bullish side, to new highs by the end of the year, or are we going to end up retesting those June lows by the end of the year? Like I said, share whatever your thoughts are down in the comment section down below. All right, now let's take a look at what's driving this price action. Very, very interesting move today. So by the end of the day today, you had this kind of a grouping here of safety asset classes, bonds, real estate, gold, like tangible asset class safety trade, mixed in with commodity prices, which is kind of interesting that commodities would rally with a drop in yields. Usually commodities are rallying with a rise in yields, but commodities rallied today with a drop in yields. Pretty significant drop in yields. CLT is down 1.5% or up 1.5%. And also small cap stocks. Small cap stocks, again, a lot of those meme stocks really pushing IWM a lot further higher than a lot of these other equity asset classes. I mean, to a abnormal high point, which again, it's, how much do we expect that to be sustained? If you look at, their relative strength chart here, this is on the daily chart. The Qs, basically drop down below the 30-day moving average. But keep in mind, like when this goes down, like it has pretty much since the beginning of the year to the mid-June low, it's bearish for the markets in general for this to go down. So if we, again, have a similar scenario where Best Buy spiked in March, and then that sparked a run on the Qs to underperform IWM, it actually coincided with a drop in the Qs, not with a rally in the entire markets. So I don't know if we necessarily want to see IWM outperform like that, because it usually triggers something more of a kind of a underperformance. If we take a look at the chart for TLT and those bonds, you can see after finishing the week last week with a drop back below the 17-day moving average and a bearish divergence to the downside, we did close back up above the 8-day moving average. And remember, there's a big gap in volume here. We moved down so fast this year, which interestingly enough, on a correction. I mean, this is one of the few corrections you actually see long-term bonds decline. Like again, fourth quarter 2018, you can see bonds rallied right there, right in this little chunk right there. In 15 and 16, bonds rallied into 15, into the 16. 2011, bonds rallied on the credit crisis downgrade. In COVID, bonds rallied. Bonds were rallying going into COVID. And so here's a big time correction. Not only did bonds not rally, but bonds were in a bear market, right? They had their correction, they had their failed correction bounce, and then they broke. This is a 200-week moving average. Bonds are in bear market mode. And again, it's usually currencies, bonds, stocks, and commodities. So if stocks are in correction mode right now, then you can kind of see what may be looming for stocks going into next year if they perform similarly to what bonds did. Remember, bonds took off going into COVID, and then stocks pretty much mimicked that move coming out of COVID. So are we going to get a similar where stocks follow suit? That bonds are starting that move, but you can see that now, if we are going to go into a little period of risk aversion, this time you would expect bonds to maintain some bullishness, and you can see can really start to get bullish because there's just no resistance above you once you kind of break this 120 area, which is the high point that we got last week. If we get above that high point, now that you have all these moving averages all above the 50, if we can get above that high point, then you're gonna probably bullish trend all the way up towards 150 on bonds, and you would assume that wouldn't take place along with a bullish trend in stocks. You can see commodities appear to be basing here at the 200-day moving average and trying to start a move back up to the upside. So we'll see how that plays out over the next little bit. Of course, the dollar will have a big say in that, and the dollar is kind of converging right now. All these moving averages are kind of converging here. The big relationship I've been paying attention to on the dollar is compared to the yen. And the dollar's been so bullish against the yen. The yen is considered a safety trade. And we've had a good rally last week on the dollar against the yen, along with equities. But today, it looks like we're kind of, again, meeting up against some resistance and potentially having a pullback and then a failed pullback bounce that you would expect to lead to a correction. That's what it looks like on the weekly chart. You would actually start with a correction. Like we said, we hadn't had a pullback yet because we didn't even get to we never did finish below the 17-week moving average. And remember, the MACD is already well below its moving average. So at best, you're going to converge, right? Where you don't go up very much. At worst, we're going to start to diverge where we follow on price, where the MACD is already saying, is already trying to lead it to. Let's move this up to, there we go, to that high point there. From a sector rotation standpoint, here's how the sectors moved today. So again, remember how it was kind of a meme stock kind of a day, right? Well, you can see our big winners. Our big loser was XLK. Chip stocks got hammered. Nvidia got hammered. Everything else was flat, and up to the upside you had real estate stocks, you had material stocks, you had energy, you had XLC and XLY both did well. Healthcare, utilities, all kind of outpacing. So what started out really strongly on discretionary and communication services really strongly ended up kind of lagging behind the real estate, which maintained most of its strength throughout the day. Again, it's more of that safe haven areas, tangible asset class there, especially with, like I said, yields. Yields are showing us an interesting picture because the market's trying to price in more rate hikes, the futures market, but the bond market is just not sold right now. And I did tweet this out earlier too, if I can find it. I tweeted this out earlier too that remember, the Fed is the goal of the Fed is to keep unemployment low and keep inflation low. Well, unemployment is really low. To like historic lows and at all-time lows in individual states, and inflation is really high. So what this tells you is that you don't need to have low interest rates anymore, because you should be great, right? You should actually be starting to rein that in a little bit, especially when you consider that inflation levels are also really high. So both of these kind of tell you that the Fed should be a little bit more restrictive right now, because of how strong unemployment rate is in terms of being really, really low, and how high inflation is. That they should be a little bit more restrictive to cool some of this off. And they're saying that the neutral rate right now is way below the long-term average, which doesn't really make sense to me. But that's, right now, the bond market is saying that that's where the rate is. We're right about 2.75, which is really only another quarter basis point hike from here. One more 25 basis point hike, and the market's still pricing in, a pretty high probability. We're not baked in, not above 80% yet, but a relatively high probability of 75 basis points, which would pretty much start dragging the 10-year yield up along with the Fed funds, which is very similar to what happened in the 70s, especially the late 70s. All right, now let's take a look at our trade idea for the day, and I wanted to take a look at Delta Airlines. Let's bring up Delta here. You can see it's been moving up into its own areas of resistance, Fibonacci resistance. You got this 38% line on this current intermediate decline it's on. You'd actually probably go a little bit further, but this is where it really kind of took off to the downside. Then you also notice you've got this kind of more longer term line from, let's see, I need to go back even further, don't I? This longer term line from the COVID drop that we had rallied up to the 78% retracement, couldn't get through it to change the trend, held it. Got back into the retracement zone between 38 and 62, kind of been fluctuating around there, broke the 38. Last time we broke the 38, came right back up. This time we've stayed, and now we've come up to retest and currently are sitting right at it. Right at that 38, as well as this current drops 38% retracement level. So multiple retracement lines on the same indicator. You can see strong bearish patterns rising, but strong bearish, it's easily in bearish territory. The near term line up above 80, but not very much. So, and of course the week's not over with. You can see again, you got your intermediate lines up here in this strong bullish posture. We're more than 8.5% above, but over here in March we were even further above that. So 8.5% is actually not a very strong number, for what we've seen. It is a peak relative to other areas that weren't nearly so bullish as what we saw there in March and April, when again these kind of reopening stocks went kind of so parabolic there. Let's take a look at some of these other charts. You can see we are sitting right at the 10-week, but we are still in death cross environment there. Looking at like the DMI for Delta, we are above 25. But we are not just below 20, but we're way below 20. We're down there to 15, which is a significantly low level. If you look across, it's about as low as we get. We maybe get a little bit lower, but usually when we've gotten to these levels, the positive is so much higher. The only other time that it wasn't was right here, and again we couldn't get going, and that's I looks kind of the same kind of pattern that we see going on here, where we're just not very bullish, given how bearish that negative directional indicator are. You can see that too on the RSI and the CCI. The RSI is moving up into that 60 level for resistance, whereas all these other times it easily got through 60 and got up to 70, while we're getting a divergence on the CCI, lower highs with higher highs going into that resistance level there. And then looking at the Bollinger Bands for Delta, you can see again that we are below the value area because we broke down, and as of right now we're retesting that breakout to the downside, but so far holding without getting, none of these breaks here was able to get through the 100 level, to change the trend, right? So a situation like that, I want to set up an opportunity to take advantage of the rally with more of a bearish trade to the downside. So I'm going to sell the 31 put, buy the at the money put there at 34. So position size, like I normally do for a directional trade, just about half a normal position, but going for nearly a 2-to-1 risk-reward ratio, or reward-to-risk ratio. So pretty decent reward. You can see the max gain is easily inside of 1 standard deviation. So a very easy opportunity for it to get below, if it does, get below 31, getting below the low point in between the divergent highs and setting up for it. Like I said, it's hard to get lower lows unless you're coming down from either a lower high or a divergent high, which I mentioned before. This would be one of those divergent highs that could get us below that low point to a lower low. All right, well, that does it for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any thread there with any questions or comments you have about today's video. Reply to anybody else's threads. Let's keep this conversation going between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow, like us on Twitter and Facebook. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.